Sir, how do I indicate to you that you have to end or you have to start?
नहीं, हाथ दिखाएंगे तो चलेगा ना? स्टार्ट करना और एंड करना।
ठीक है. To approach or present your plan to an investor, you have to keep certain important things in mind. I'm going to list those. I'm not going to get into very obvious stuff like list your team, list your industry size, etc. I think that some things are common sense and hence my time would be better utilized in telling you some other important things. Here is one absolutely suicidal thing that a lot of entrepreneurs do, like close to half the entrepreneurs do this. Between the time they are at the stage that you are at, namely, you have not yet made your roadmap on approaching investors, and the time when they'll actually have the final business plan, information memorandum, PowerPoint slide, and their presentation is ready and slick and the spreadsheets are ready, there is an intermediate period when they start exploring. Now the problem is that in any country of the world, definitely so in India, the investment community is very, very small. Everybody knows everybody. So I know, I'm exaggerating only a little, I know all angel investors in India, 80% of the venture capitalists in India. Right? In light of the fact that we know each other, let's say you approach me at a very preliminary level, such as after class today, and you share with me things which you actually would not have wanted to share when you actually make a pitch to investors. Do you understand what I'm saying? Now the problem is, you have let the cat out of the bag. Okay, like for example, you come to me and say, actually, you know, we have only one customer, but we send bills in 5 names. So when I approach investors, should I say I have 1 customer or 5? I'm just giving you an exaggerated example for effect. But you have told this to whom? Told this to a person who knows every investor in this country. Right? So fine, I'll tell you what to do. I'll always say, hey, be truthful. Right? Because who will you lie to? To investors, right? So I'll tell you, you understand what I'm saying? But now what has happened is you have exposed this rudimentary thought. Right? So you are saying, you know, actually we are 3 co-founders, but one of them we are not able to get along with. Okay, but he is also our biggest investor and his father is very influential, so we are having trouble getting rid of him. Should we get rid of him first and then approach investors or later? So this is all I have heard from you, and 6 months later I see you pitching somewhere where all 3 founders are still there. Are you understanding what I am saying? So this intermediate period between when you are an innocent person and when you are a married person, right, in the investment stage, the mistakes you make here will come to haunt that marriage prospect. Do you understand? Yeah, this everybody has understood, right? Okay, so this is one thing that I'll tell you. In journalism, they say nothing is off the record. So, you know, you meet a journalist and say, listen, off the record, can I tell you something? And you tell them. So they say in journalism, nothing is off the record. That's exactly what I'm telling you. But please be careful of who you talk to and what you say. The second thing is, early stage investors are fairly irrational creatures. If you move to the private equity stage where your financial statements themselves speak everything about your business, it's a different story. But otherwise, early stage investors are a pretty crazy lot. Let me prove it to you beyond doubt. So at Mumbai Angels, we have invested roughly 70 companies over the last 5 odd years. More than half of these companies today are doing a business different than the one they were doing when we invested in them. Do you understand? So this is commonly called plan B or pivoting. You have heard of these terms, right? So more than half of these businesses have pivoted and are doing plan B. We know this. See, at that time we may not have known this, but now we know this. In light of that, if today you present a business plan to me, how much merit is there for me to spend excessive energy in evaluating that business plan when I know there is a greater than 50% probability that it's going to change? You understand? So when you talk to early stage investors, a large number of them will say, you know, frankly, the business plan doesn't matter, the team matters. I think that is one of those platitudes, those extreme truths which everybody has to believe. But the fact is, despite the fact that they say this, look at how they evaluate you for investment. Yes, they will look at the team. I'm not saying they'll not look at the team, but 95% of their evaluation would be based on your product, service, offering, market, competitors, namely your business, which they know there is a greater than 50% probability of changing. Do you understand the irrationality? Is this very clear? So, when you are dealing with somebody who is making an extremely important purchase decision, investing in you is a purchase decision, and that person is irrational. Okay, because the person could either look at color or taste? And the person says, I only look at color, taste will change over time. Namely, I only look at team, plan changes over time. And the entire evaluation is done on taste. You see, there's something crazy about that, and I have seen this happen over and over again. Right? In light of that, you will be the sufferer in the following ways. You are making a presentation. First, you begin by saying, India's population is this much lives in cities A, B, this is their purchasing, blah, blah. So there is 120 crores, out of which 1.2 crore, 1% is my market. You say this, and investors are like, yeah, we have heard this many times before. Why? Because these aggregate global numbers mean nothing to me. Right? But the interesting thing is, try to leave this out of your slide deck and now go to the investor. They will say, you haven't told us what is your TAM is, which is total addressable market. Do you get what I am saying? I have found that if I were an entrepreneur pitching to investors, and I have done that, but in my case, I pitched to one investor in December of 2007, and in March of 2008, that investor gave me a check of 11 crore rupees. So I was very lucky. I went to one investor a couple of times, revised some of the things that they wanted, and that investor gave me. But today, when you have to go to these dozens of investors, I would really die of frustration because of, if you do this, you do A, they want B. If you do B, they'll say, why did you not do A? Right? So if you don't mention team, they'll say team is everything. If you spend too much time on team, they'll say, but you have not demonstrated your product. So the problem is, the crux of this problem is that investors are not able to assess your business plan. Why? Because it's too early. If you were at a later stage and you had done a lot of business, I could look at your track record and try to extrapolate it using whatever statistical or intuitive method that I know. But at an early stage where you are still close to an idea and you're just getting started, I as the investor do not have an ability to judge you. For instance, if you have heard about it or read about venture capitals or capitalists or angel investors, you would have heard that they say 1 in 10 businesses succeed or 2 in 10 businesses. I am not talking in general, I am talking of the businesses that they invested in. Oh, so that means 8 out of 10 don't succeed, 9 out of 10 don't succeed. So what value did the venture capitalists add in terms of selecting businesses if all that can be done is 1 or 2 out of 10 succeed? But that is the nature of the game, and it is not so much the presence or absence of skill or ability in the venture capitalist. It is more that when you invest in early stage businesses, mortality rates are higher. In light of that, so now put yourself in the investor's shoe. If this is the predicament of the investor, namely they can't assess you, let's put it this way, they cannot assess you, but you still have to show that you are a good bet, what should your pitch or presentation to them do? What should it do? You want to sell to a customer. So let's say you have a retail outlet that sells furniture. Okay, so now there are 2 sofa sets. One of them costs 18,000 rupees, the other costs 80,000 rupees. The customer can afford both, right? Your job is to tell them to buy the more expensive one. Now, what is it that you would do which you can't say this one is garbage, right? Otherwise, why are you selling garbage? What is it that you would do to try to make the sale where the customer has sat on both and they feel the same, it looks similar? What will you do? You will say this is made of Burma teak. Yeah, fine, that's inside, right? Yeah, that is okay, probably it means something. But what is it that you will do to a customer who is not a sophisticated buyer? Do you understand my problem? I am saying all early stage investors are not sophisticated buyers because they are largely lost. How do you convince such a person? Give me suggestions.
Urgency, create the urgency that this is running out or something like this.
So your point on urgency, I'm going to accept with a slight twist, but we'll keep it in mind. I'm collecting the points, then we'll look at all of them together.
Maybe realize what is the value addition to that customer, which gives more value to them.
Okay, in the case of the sofa, I kind of agree with you, but in the case of investment, how would you show that?
In terms of monetary, like
Okay, you invest in me.
Requirement, you just judge that and put him in same language.
Fine, so understood. So your point, which I am adapting a little, was about timing. When you say urgency, I am calling it timing. Okay, your point is about alignment of interests. That you know what, you want this, and guess what? That is exactly what we do. Interesting. What else could you do?
X profit will be greater than Y. Like, in the case of sofa set, investing in 80,000
will give you a superior outcome to whatever you are looking at. You would have a higher social profile, it would last longer, or whatever it is. Okay, whatever you are looking for, this is a better option. You said something. Opportunity, as in you try to create a sense that you have not fully understood the phenomenal outcome that will occur. Now what I'm going to do is I'll try to collect all of these.
Resale value can be bigger.
Yeah, in the case of investment, of course, in the case of sofa also, but in the case of investment, the resale value I think is everything, right? When somebody is investing equity. Now, here's what I want you to do. And I'm actually revealing some secrets about how I evaluate businesses, knowing that I don't know how to evaluate businesses. So, starting from that point where I know I don't have a crystal ball where I can gaze into the future, one of the things I do, you should know that the process of raising money, even from an investor who is keen to give you money, will easily last you a 3-month period, probably much more than that, right? It's not overnight, it's not an application you give and in 2 days you get a result. I very closely watch what happens in this period. See, when somebody comes to me and says, this has happened in the past, great, of course I am impressed or unimpressed by what has happened in the past, but what gets me moving is what is happening while I am engaging with them. Because if this is the point of time where a lot of traction occurs, more customers, more product deployment, bigger pipeline, greater orders, recognitions, empanelments, whatever is traction in your case. So as I am watching that traction, my fear of missing out on this opportunity, you said opportunity? No, you said opportunity. My fear of missing out on this opportunity gets greater and greater. Okay, so what happens is, not just do you have to tell the investor why this is a good business to invest in, which is obvious, you also have to tell them why now is the correct time to do it. So the urgency thing that you said, which I am regarding as timing, you have to tell them why now is the correct timing. And how would you do that? You can't tell them that elections are around the corner, after that this will happen, because that's all forecasts. Right? And forecasts are limited. You will say that okay, internet penetration in India is so much, it is going to become so much, 4G will be launched, blah blah. So that is all future predictions. Already the investor is suffering from so much uncertainty about the future that you are only adding more variables to it. Variables you think you know the value of. However, if you can demonstrate, instead of today me telling you, I'll sell you a cake and the cake will be like this, and it will have cherries here and this. Instead I bring you the cake and say, eat it. The proof of the pudding. So how do you do that to an investor? It has nothing to do with your presentation at all. It has to do with their observation of you. Namely, when you are engaging with them, if stuff is happening, I think that is the greatest driver. In fact, when companies have presented to me, there is a whole lot that I will not want to consider because something is like totally beyond my acceptable set. But the ones that I consider, I eventually invest in 1 out of 10 out of these. Forget the ones I don't consider. Now there could be good opportunities I might have lost, but we'll ignore that. So within this I invest in 1 out of 10, or probably the real number is 1 out of 8 out of these. In light of that, how do I choose that one? I am interested in all of them. How I choose that one is based on many factors, one of which is how I observe their business grow, which means whatever has happened up to today is fine. How I see things happening, like they tell me we are approaching these 4 customers and 3 weeks later I hear that this customer has given an order. That is fabulous. You understand? So this is the proof of the pudding, right? The second approach, now this is really my personal approach. It may not be the ones about something that other investors focus on, but the fact is that regardless of what I told you, we actually end up putting our bet on the entrepreneur, right? Now, what are the entrepreneur risks that I face? Forget the business risks. Customers may not buy, product may not be good, competitors may come. Those are business risks. What is the entrepreneur risk that I face when I invest in early stage startups? Capability problem. Yeah, sustenance of interest. They might lose interest. Today we can't believe that Mukesh Ambani would lose interest in Reliance Industries, right? But an early stage entrepreneur might lose interest. So capability, interest, what else? You have missed out the biggest one, I must tell you. Although these are also important, but the biggest one. Confidence, actually I'll put it in the same trait as ability to deliver. So fine. Okay, you are now moving to business, and you know what? I'll tell you. Basically the honesty. As an investor, what my biggest terror is not that the business will not succeed. One would, theoretically think that I would worry that the business I invest in will not succeed. My biggest fear is, if it fails, I understand it fails. My fear is if it succeeds and I still don't make money. To begin with, there was a huge probability of failure. I bore that risk. I clenched my teeth and I said, you know what? I'll tell you this. Every time I invest, I'm very excited. Few days later, I'm regretting big time. Nothing has happened. Okay, nothing has happened in those few days. What is happening is I'm like, what the hell did I do? Once again, some more money lost, blah, blah. So that is my approach. I don't know if other investors think this way or whether they think this way but not confess to it. But whatever that is, the biggest fear is about not making a return. But why would you not make a return? Because the business doesn't do well. So far it is rational. The irrationality comes in when the company makes money and you don't make money. And I'll give you an example which is commonly understood. Look at all the stock market listed real estate companies. There are close to 5, 6, 10, whatever number of real estate companies, builders, developers who are listed. We know that the ratio of cost of land plus construction to the eventual sale price of the property is very favorable to the builder. They can make it in all of this put together in 3,000 rupees a square feet, they sell at 12,000 rupees a square feet. Right? Furthermore, customers fund or subsidize part of it because they pay advances. Despite all of this, companies which are listed on the stock exchange are not giving returns to investors. In real estate, which is the only most stable asset class as is proven since independence, what do you make of it?
Integrity.
I don't know, maybe they are accepting a lot of money in cash, right, which is not percolating down to me as a stock investor. I don't know, but on the one hand I know if I myself go and buy an apartment, in 4 years it doubles. That means the rate of return that I can expect is close to 20% or 18% in buying a finished good. Here if I buy a raw good, mainly I give it money to the developer who will then buy land and build it up, the return has to be much higher, but the return is very, very low, close to zero. So how do you explain this? Maybe I invested in the wrong company, but as a category, real estate companies are not giving good returns. How do you explain that? My fear is it has to do with integrity. This is what I am talking about. The biggest fear that an investor has is not that the business will fail. The biggest fear is the business will fail, yet the business will succeed, yet the investor will fail.
Can you pull it up at this stage and
Okay, what you can do, so what I'm going to do is I'm going to move this to a few minutes later about post-investment decisions, because we have only about 20 minutes. For now, what I'll tell you is I'm actually trying to put this all together. You have to come across in whatever you say as an extremely honest person. So somebody who comes and tells me as an investor, what I do, I went to that school and I told them this. Okay, that means he's hoodwinking his customer, right? And he's selling this to me to show, see how smart a businessman I am, right? You have closed all doors right there. As in I am saying, even if there's a minor suspicion, for instance, one of the companies that we were all, as in me and my friends were about to invest in, let's put it this way, everything was perfect. Company was making a lot of money, it was number 2 in the marketplace, it was in the digital product space, everything was perfect. Okay, and we were in the final stages and somebody pulled it up on the internet and realized that one of the promoters was one of the accused in the Harshad Mehta scam 15 years back. Matter over. You understand? Because integrity is so important. So you have to show that you are the right people. Then you focus a little bit on why the industry is good, why the market is good, why your business plan is good. Most people stop here. Most people will say, consumer durables are growing at so much, the players are this much, this is a segment which is not being serviced, so this is what we will do. And they think that they have done enough. Right? I am going to conclude by telling you an example about why that is not enough. So I was talking to a group of college students. This was an engineering college and I told them to come up with a business idea. And one of them said, you know what, we have Tropicana, Real, etc. selling juices. What do they sell? Orange juice, apple juice, pineapple juice and various cocktails. But Indians drink sugarcane juice and nariyal pani, which nobody sells. Sugarcane juice, according to me, nobody has tried to bottle up. Nariyal pani, some people have made some attempts. So you know what I'll do? I'll bottle up sugarcane juice. So this is like saying, here is a market, so many Indians, they drink sugarcane juice, they are always worried that flies will get crushed into it. They would be very happy to drink hygienic sugarcane juice. Multinationals who have come in and are selling their usual orange juice do not understand the Indian characteristics. Hence, this is a good business opportunity. My answer to them is, yeah, it's a good business opportunity. Hence, Tropicana should do it. Are you understanding what I am pointing out? You don't just convince me on the business opportunity, you also tell me why you are the right people to do it. Do you understand? This also is why when entrepreneurs come to me and say, sign this NDA, and only then I share my business plan with you, I'm like, please don't share it with me. I talk to over 1,000 teams per year. Literally, I talk to over 1,000 teams per year. And now if I sign an NDA and 20 of those teams are doing a business very similar to yours. And the fact is, like, let's put it this way. Let's say you can make cola, which is tastier than Coca-Cola or Pepsi. You really think you'll beat them? Your neighborhood auntie in every case makes better chocolate than Cadbury. And then we all have some auntie who lives close by, okay, who makes great chocolates, right? Especially with the filling she puts in, because frankly the raw material is almost identical in all cases. Do you think she's going to beat Cadbury? So please do not only focus on your business plan. When people say business plan doesn't matter, but keep evaluating business plan, and they say team matters, but don't spend enough time, you marry the two of these and say great industry, great market, which by the way it better be, otherwise you should also not do the business, forget what the investor thinks. Great business plan, here's why, and you know what? We are uniquely positioned to be the guys who do it because of this reason. This jump is very difficult to do, very few people manage to do it, and guess what? Very few people manage to raise money, right? Thank you very much. Your lecture is not over.